Hi, I'm Mark. Before we start, I want to tell you something true about me. I have been wrong before, and I will probably be wrong again. So take everything I say today and check it against your own accounts, your own numbers, and your own advisor if you have one. That's not a disclaimer I'm reading because a lawyer told me to. It's just how I try to live. Today I want to talk about two dates that matter more than almost anything else in your retirement. Not a stock tip, not a secret, just two dates and two rules that the government already wrote down in plain sight. Most people never sit down and actually read them, so today we will.
The first date is age 73. The second is the window between age 62 and age 70. If you get those two right, you keep more of your own money. If you get them wrong, you don't lose it to some scheme. You lose it to taxes you didn't have to pay and to a smaller check every single month for the rest of your life. Let me start with a story from a time you probably remember. Picture the fall of 2008. If you were near retirement then, you remember the feeling. Stocks were falling almost every week. The news was full of bank names that used to feel as solid as a mountain. Some of those retirees had a rule waiting for them that year that had nothing to do with the stock market crashing. It was a rule that had been sitting quietly in the tax code the whole time. It's called the Required Minimum Distribution, or RMD for short. Here's what an RMD is in plain words. When you put money into a traditional IRA or a 401k, the government let you skip paying tax on that money going in. That was the deal. The government said, fine, we'll wait, but the government does not wait forever. Starting at a certain age, the IRS makes you pull money out of that account every single year, whether you need it or not. And when you pull it out, you pay regular income tax on it, just like it was a paycheck. In 2008, that age was 70 and a half. A lot of retirees that year had no choice. Their account statements were down. Some were down 20, 30, even 40% from the year before. And the IRS still said you must take this exact dollar amount out this year, based on last year's balance, whether the market agrees with you or not. So people who could have waited for the market to recover instead had to sell shares at the bottom, just to follow the rule. That one timing mismatch, a falling market crossing paths with a forced withdrawal, cost real families real money that never came back. I bring up 2008 not to scare you. I bring it up because the rule that hurt people back then still exists today, just with different numbers. And once you understand how it works, it stops being something that happens to you and starts being something you can plan around. So let's get to today's numbers. As of right now in 2026, the age when RMDs start is 73. That's because of a law called the Secure II Act, passed back in 2022. It raised the RMD age from 72 up to 73 for most people born between 1951 and 1959. If you were born in 1960 or later, your RMD age is even later, 75. So the exact year this hits you depends on the year you were born. That's worth checking today, not later. Go find your birth year and figure out which age applies to you. Here's the part almost nobody explains clearly. Your RMD is not some number the IRS picks out of the air. It's simple division. You take your account balance from December 31st of last year, and you divide it by a number called a life expectancy factor, which the IRS publishes in a table. That's it. Balance divided by factor equals your required withdrawal for the year. Let me give you a real example, one the IRS itself uses in its own instructions, so you can see the math with your own eyes. Say someone turns 75 in 2026. Their IRA balance at the end of 2025 was $100,000. According to the IRS table for someone that age, the factor is 24.6. $100,000 divided by 24.6 comes out to a little over $4,000. That's the amount they are required to withdraw in 2026. Not a penny more required, but not a penny less allowed either. Now here is the number that should get your attention, and this one is not made up for drama. If you miss your RMD or you take out less than you were required to, the IRS charges a penalty of 25% on the amount you should have withdrawn. 25%. That used to be 50% under the old rules, so it has actually come down, but it is still a painful number to hand over for simply forgetting a deadline. And if you catch the mistake and fix it within 2 years, the penalty drops to 10% instead of 25%. So if you ever realize you missed one, don't panic and don't hide it. Fix it fast, because speed cuts the penalty in more than half. The deadline itself is worth writing on your calendar right now. For most years, your RMD must come out by December 31st. There's one exception, and it only applies the very first year you're required to take one. In that first year only, you get until April 1st of the following year. But here's the catch almost nobody warns you about. If you wait for that extra time in your first year, you'll end up taking 2 RMDs in the same calendar year, the delayed one from the year before and the regular one for the current year. Both count as taxable income in that same year. For some people, that pushes them into a higher tax bracket than they expected, just because of timing, not because the Y made more money. So sometimes the smarter move is to just take your first RMD on time in the first year, even though you technically didn't have to yet. Let's talk about the second big decision, the one about Social Security, because it works almost exactly opposite to the RMD rule. With RMDs, waiting can cost you a penalty. With Social Security, waiting is usually what pays you more. You can start collecting Social Security retirement benefits as early as age 62. A lot of people do because they want the income, or because they're worried the system won't be there later, or because they've simply had enough of working. That is a completely fair choice. But here is the trade-off you need to see clearly. If your full retirement age is 67, which it is for almost everyone born in 1960 or later, then claiming at 62 locks in a permanent reduction of 30% compared to what you'd get by waiting until 67. Not 30% for a few years, 30% for the rest of your life. Now flip it around. If you wait past your full retirement age, your benefit grows by roughly 8% for every year you delay, all the way up to age 70. After 70, delayed credits stop. There's no reward for waiting past 70, so that's the real finish line. Someone who waits until 70 instead of claiming at their full retirement age of 67 ends up with a benefit that's about 24% higher than the full retirement age amount, and about 77% higher than what they would have gotten by claiming at 62. Let me put real numbers next to that so it's not just percentages floating in the air. The Social Security Administration publishes maximum benefit figures every year for workers who paid in the maximum amount for 35 years. For 2026, those numbers are $2,969 a month if you claim at 62, $4,207 a month if you claim at your full retirement age of 67, and $5,181 a month if you wait all the way to 70. That's a gap of more than $2,000 a month between the earliest and latest claiming age, for the exact same person, based only on when they decided to start. Most people, of course, didn't pay in the maximum amount every year, so their numbers will be smaller. But the percentages are the same no matter your income level. Whatever your full retirement age benefit would be, claiming at 62 gives you about 70% of it, and waiting to 70 gives you about 124% of it. Those ratios hold steady whether your benefit is $500 a month or $5,000. So which is right for you? I'm not going to pretend there's one universal answer because there isn't. If you're in poor health or you badly need the income now, claiming early can be exactly the right call, even knowing the check is smaller. If you're still working past 62, there's another wrinkle worth knowing. Until you reach full retirement age, Social Security has an earnings test. In 2026, if you're under full retirement age all year, you lose $1 of benefits for every $2 you earn above $24,480. In the year you actually reach full retirement age, that rule gets more generous. $1 withheld for every $3 earned above $65,160. And once you hit full retirement age, the earnings test disappears completely, no matter how much you make. If you're a surviving spouse, there's a separate set of rules built just for you, and they matter just as much as the ones we've already covered. Survivor benefits based on a deceased spouse's earnings record can start as early as age 60, 5 years earlier than a worker's own retirement benefit can begin. That earlier starting age exists because losing a spouse can create an urgent need for income that regular retirement rules don't account for. If you're a widow or widower, it's worth sitting down with the Social Security Administration directly and asking them to run both numbers for you, your own retirement benefit and your survivor benefit, because in many cases you're allowed to claim one first and switch to the other later, whichever order gets you more money over your lifetime. This is not something a website can calculate perfectly for your exact situation. It's worth an actual phone call or an actual appointment. Here's a detail that surprises a lot of people. Money withheld under the earnings test isn't gone forever. Social Security actually recalculates your benefit later to give you credit for what was withheld once you reach full retirement age. It just feels like a penalty in the moment, when really it's more like a temporary pause. There's a third piece to this puzzle that almost nobody connects to the other two, and it's Medicare, specifically something called IRMAA, which stands for Income-Related Monthly Adjustment Amount. Here's the plain version. The standard Medicare Part B premium in 2026 is $202.90 a month. That's what most people pay. But if your income crosses certain lines, Medicare charges you more, sometimes a lot more, for the exact same coverage. Here's how the lines work. If you're a single filer with income above $109,000, or a married couple filing jointly above $218,000, you move into a higher tier. And this isn't a small bump. At the very top tier, for people earning $500,000 or more as an individual, or $750,000 or more as a couple, the total Part B premium jumps all the way up to $689.90 a month per person. That's more than 3 times the standard rate. Part D prescription drug coverage carries its own added surcharge too, running from about $14.50 up to $91 a month, on top of whatever your drug plan already costs. Now here's the detail that catches people off guard every single year. Medicare doesn't look at your income from this year or even last year. It looks at your tax return from 2 years ago. Your 2026 premium is based on your 2024 income. So a big withdrawal, a Roth conversion, or a large RMD you took 2 years ago can raise your Medicare premium today, long after that income is spent and gone. This is sometimes called a cliff, because crossing a threshold by even $1 can trigger the entire next tier, not just a partial increase. This is exactly why the RMD and Social Security decisions we just walked through don't live in separate rooms. A large RMD this year doesn't just get taxed this year. 2 years from now, it can also raise what you pay for Medicare on top of the tax you already paid. If you experience a genuine drop in income, say from retiring, losing a spouse, or losing a source of income, there is a way to fight back. It's called a life-changing event appeal, filed on a form called SSA 44. If your 2024 income doesn't reflect your real, current situation, the Social Security Administration can use more recent numbers instead. Most people who qualify and actually file this appeal get it approved. Most people who qualify never file it at all, simply because they don't know it exists. Now let's connect all three of these rules, RMDs, Social Security timing, and Medicare, because they don't live in separate boxes. They stack on top of each other on your tax return and your Medicare bill alike. If you claim Social Security and you're also pulling required withdrawals from an IRA at the same time, both of those add to what's called your combined income, and that combined income decides how much of your Social Security benefit actually gets taxed. Here's how that works plainly. For a single filer, if your combined income falls between $25,000 and $34,000, up to 50% of your Social Security benefit can be taxed. Above $34,000, up to 85% of it can be taxed. For married couples filing together, the numbers are $32,000 to $44,000 for the 50% tier, and above $44,000 for the 85% tier. These thresholds haven't been adjusted for inflation in a very long time, which is exactly why more retirees get pulled into paying tax on their Social Security every year, even though the dollar figures in the law never moved. This is where the two rules start to matter together instead of separately. If your RMD pushes your income higher in the same year you're also collecting Social Security, you can end up owing tax on 85% of your Social Security check on top of the tax you already owe on the RMD itself. That's not a trick. That's just what happens when two separate income sources land in the same tax year. So now let's talk about two simple tools that can actually help with this. Real tools, not tricks, both written directly into the tax code. The first tool is called a Qualified Charitable Distribution, or QCD. Here's how it works. If you're 70 and a half or older, you're allowed to send money directly from your IRA straight to a qualified charity. That transfer counts towards satisfying your RMD for the year, but here's the important part. It is not counted as taxable income at all. Not 50%, not 85%, 0%. In 2026, you can do this for up to $111,000 per person. So if you're charitably inclined anyway, and you're facing an RMD you don't actually need for living expenses, sending it straight to a cause you care about can satisfy the IRS requirement while keeping that money completely off your tax return. The second tool is the Roth conversion, and the timing on this one really matters. A Roth IRA is not subject to RMDs at all during your lifetime. So in the years before your RMDs start, especially if you have a lower income year, you can choose to convert some of your traditional IRA money into a Roth IRA. Yes, you'll owe tax on the amount you convert in that year. But once it's in the Roth, it never generates a forced withdrawal again, and it grows tax-free from that point forward. The real skill isn't doing this once. It's doing it steadily in your low-income years in your 60s, before the RMD clock ever starts ticking. People who plan this early usually end up with smaller, more manageable RMDs later, instead of one giant balance forcing a giant withdrawal at 73. Now I want to give you a comparison from history, because this isn't the first time forced withdrawals have crashed into bad market timing. Go back to 1999 and 2000, right before the dotcom crash. A lot of retirement accounts were sitting heavily in tech stocks that had run up fast. When the crash came in 2000 through 2002, some of those same accounts lost more than half their value. Anyone required to take withdrawals during that stretch faced the same problem retirees faced again in 2008. selling into a falling market because the calendar said so, not because it was the smart move. 2 different decades, 2 different crashes, and the exact same lesson both times. A forced withdrawal doesn't care what the market is doing. Only you can plan around that by managing your account mix and your withdrawal strategy well before the year the rule kicks in. There's actually a third lesson buried in both of those decades, and it's about where your money sits, not just how much of it there is. In 1999 and 2000, a lot of retirement money was concentrated in one type of investment, tech stocks, because that's what had been winning for years. In 2008, a lot of retirement money was concentrated in real estate and financial company stocks, because that's what had been winning right before that crash. Both times, the people who got hurt worst by a forced RMD in a down year were often the ones whose entire account sat in whatever had just been popular. The people who came through steadier usually had a mix, some stocks, some bonds, some cash set aside specifically so they wouldn't be forced to sell the falling part of their account just to satisfy a withdrawal rule. That's not a stock pick. It's a structure. And structure is something you control long before any crash arrives, popular or not. Let me give you one more worked example, this time about the Medicare side, using the same kind of straightforward math the government itself publishes. Picture a married couple, both on Medicare, with a combined income of $258,000 from a mix of IRA withdrawals, Social Security, and a pension. That income lands them just inside the first IRMAA tier, above $218,000, which means each of them pays an extra surcharge on top of the standard Part B premium, adding up to a little over $2,000 a year for the couple combined. Now imagine one of them is considering a Roth conversion that would add another meaningful chunk of income in the same year. Because Medicare looks 2 years back, that decision made today wouldn't show up as a higher premium until 2 years from now. That's exactly why a Roth conversion strategy has to be planned across several years at once, checking the IRMAA impact 2 years downstream for every single year in the plan, not just the year the conversion happens. A decision that looks smart on paper this year can quietly cost more at the doctor's office 2 years later if nobody checked that far ahead. Now, some of you listening are thinking, why not just leave the money in the account and deal with RMDs later, or delay Social Security as long as possible no matter what? Let me push back on my own argument for a second, because a fair answer has to include the other side. If you're in poor health, or you have a shorter life expectancy for any reason, waiting until 70 for Social Security might mean you never collect enough extra to make up for the years you didn't collect at all. The break-even point between claiming at 62 and claiming at 70 usually lands somewhere in your late 70s to early 80s, depending on your exact numbers. If you don't expect to live much past that, claiming earlier can genuinely be the better math for you personally, not just the more comfortable choice. And for RMDs, if you're still working past your RMD age at the same employer that sponsors your 401k, and you don't own more than 5% of that company, you may be able to delay RMDs from that specific plan until you actually retire. This is often called the still working exception. It doesn't apply to IRAs, and it doesn't apply to old 401k accounts from a job you already left. But if it applies to you, it's one more lever we're knowing about. There's another honest wrinkle worth naming here. Waiting to claim Social Security only pays off if you actually have some other way to cover your living expenses in the meantime, whether that's savings, a pension, part-time work, or a working spouse's income. Telling someone with no other income to just wait until 70 isn't good advice. It's advice that ignores their actual life. The math on delayed credits is real, but math doesn't pay the electric bill in the years before that higher check arrives. If waiting means draining an emergency fund down to nothing or taking on debt, the guaranteed monthly increase from delaying might not be worth the risk you'd be carrying in the meantime. This is exactly the kind of trade-off where your own numbers, your own health, and your own comfort with risk matter more than any general rule I can give you from a script. The same honesty applies to Roth conversions. Converting money to a Roth means paying tax on it now, in cash from somewhere. If the only way to pay that tax bill is to pull the money out of the account you're converting, you're often shrinking your own retirement savings just to avoid a future tax you're not even certain you'll owe at a higher rate. Roth conversions tend to work best when you have outside cash, savings sitting separately to pay the tax bill, and when you have a genuine reason to believe your tax rate later will be equal to or higher than it is right now. If neither of those things is true for you, the RMD you'd be trying to shrink might simply not be worth converting away from in the first place. Here's a story to make this real, using the exact kind of numbers the IRS itself publishes in its own guidance, not invented for effect. Imagine someone who reaches age 75 in 2026 with a $450,000 traditional IRA balance as of the end of 2025. Using the IRS life expectancy table for that age, the required withdrawal comes out to about $18,293 for the year. That whole amount gets added to their taxable income for 2026, taxed at their regular income tax rate. Now imagine that same person doesn't need that money for living expenses, and instead sends it as a qualified charitable distribution to a cause they care about. Same $18,293 satisfies the same RMD requirement, but this time, none of it counts as taxable income. For someone in the 22% tax bracket, that difference alone is worth roughly $4,000 in taxes not paid, just by choosing where the money goes. Pause here for a moment. Let that sink in. Same amount of money, same requirement satisfied, and a $4,000 difference just from knowing which button to press. So here's what I want you to actually do. 3 simple things starting today. First, find your exact RMD age. It depends only on your birth year. If you were born in 1959 or earlier, you're likely already in RMD territory or very close to it. If you were born in 1960 or later, your age is 75. Write that number down somewhere you'll actually see it again. Second, if you're anywhere near Social Security claiming age, pull up your actual Social Security statement at SSA.gov and look at your own personal numbers at 62, at your full retirement age, and at 70. Don't use my numbers or anyone else's numbers as a stand-in for your own. Yours are the only ones that matter for your decision. Third, if you're charitably inclined and you're facing an RMD you don't need for daily expenses, ask your IRA custodian this exact question. Can I set up a qualified charitable distribution this year? It's a 5-minute phone call that can save you real tax money, and it costs you nothing to ask. And one more, because it connects directly to what we just covered on Medicare. If you're within a year or two of enrolling in Medicare, or you've recently retired and your income dropped, look up the SSA 44 form. If your current income is genuinely lower than what your 2024 tax return shows, filing that form can lower or remove an IRMAA surcharge you might otherwise be stuck paying for a year you're no longer earning that much. I want to end with something honest. None of what I told you today is a secret. Every number I gave you came straight from the IRS, the Social Security Administration, or major financial firms that publish this information openly, for free, for anyone willing to go look. There's no insider tip here, no hidden filing, nothing that only I supposedly know. The only real advantage in retirement planning is being one of the people who actually sits down, does the math for their own situation, and acts on it before the deadline arrives instead of after. If this helped you think a little more clearly about your own RMD age or your own Social Security timing, do one simple thing for me. Send it to someone you know who's approaching ETH. Are of these decisions, a parent, a sibling, a friend who mentioned they're turning 70 soon? Not because I need the view count, but because these two decisions are hard to undo once they're made, and a 5-minute conversation now can save someone real money later. This video is for education only. It is not financial, tax, or legal advice, and it doesn't replace a conversation with a licensed financial advisor or a CPA who knows your full situation. Tax laws and IRS figures change and are adjusted for inflation regularly, so always confirm current numbers at IRS, Gov, or SSA. Gov before making a decision based on what you heard here. Always do your own research. I'll see you in the next one.